Hey, hi guys, everybody. Welcome to the new episode of Finance Pe Charcha. I hope you've been watching this series. We've got some very interesting guests who've made presentations around various topics, and I hope you're loving this series. This is a very interesting podcast today that we are going to do, which is on P2P lending. I keep receiving a lot of messages from all of you all to talk about P2P and various alternatives. Specifically post indexation was removed from mutual fund. P2P and various other alternative investments in the fixed income space is becoming extremely popular amongst a lot of investors. So we thought, why not get somebody who's running a P2P business to come and talk to us, help us understand the entire landscape of P2P. What things do you really look at before investing or doing P2P lending? What are the risks? What are the returns? Should you really invest or not? And to cover that entire landscape for us today, we've invited Vinay Matthew from Fairsend. Hi, Vinay.
Hi, Kirtan. Thanks for having me.
In fact, thank you so much for taking the time out to be a part of the presentation, Vinay. And I'm so glad that you are here to help us understand about P2P, because fortunately, unfortunately, in spite of P2P being around for a long time, there is so much of unlearning or probably learning that a lot of people really have to do around this space, because not a lot of us really understand how the ecosystem works. So I'm just hoping that over the next half an hour, when you guide us through your presentation, I think a lot of our doubts around P2P lending will clear. So thanks so much for taking the time out.
My pleasure.
Vinay, what I'm going to do is make you the host so that you can present to us about the P2P infrastructure that you've designed. I might ask you some questions because I might not know certain things that you might present. So please excuse my not understanding.
I think that's the idea, right? That's the idea, to kind of make everyone understand, including you. Yeah.
100%, 100%. So please don't mind if at all I ask more questions, but the idea is to kind of make this conversation more free flowing and simple for everybody to understand.
Absolutely.
Super. So I'm going to make you the host so that you can do the presentation, Vinay. Just give me a moment.
All right. So let me start this by giving a little bit of background. So most of the P2P lending businesses are two-sided marketplaces. What it means is that we onboard large number of customers on both sides. Okay? And why this is important to understand is because if you see any network effect happening in any of these platforms that you participate, right? Be it Naukri, be it Make My Trip, Book My Show. These are all two-sided marketplaces where there are two sets of customers that you have to onboard, right? So P2P lending companies also have the same phenomenon. And the interesting things about a two-sided marketplace is that the market leader takes up a majority of the market share, and you don't have many players, 4 or 5 players operating in the space. You can't name a sixth one or a seventh one, right? Unlike a brick and mortar company where you have 20 car manufacturers, all of them making money, with Maruti 50% market share and BMW 2-3% market share, right? So, but the internet doesn't work like that, and it's globally like that, right? It's not just an Indian phenomenon. Globally, a market leader takes a sizable chunk, and post that, the second guy takes maybe 20-30%, and the third guy takes 10-15%, and the fourth guy struggles. The fifth guy does not exist. So, and why this is important to realize is because you should not be participating with anybody or everybody, right? So it's important to kind of realize that who are the top guys, and you kind of participate with those guys. The other important thing is that we have to create value on both sides. On one side, we have to create value for investors who are the lenders, and on the other side, or by giving them returns. On the other side, we have to give value to the borrowers, which is the demand side. Where we have to give them loans at a very affordable or a reasonable rate of interest. Otherwise, they will walk out and take it from someone else, right? So it's important to kind of match and balance and create value on both sides. So if you can do that at scale, you create a very strong moat, and that's what builds scale. Okay? In this business, or for that matter, any category business, both sides, the value has to be driven, and that's the reason these organizations become very, very large. Now, apart from being a two-sided marketplace, there is the genesis of something called a sharing economy. Right? So the sharing economy started some 15-20 years back. Yahoo started with Yahoo Groups. People made groups and started chatting with each other. But it kind of, the next generation took it to the next level where people started to share the pictures, share the ideas, share the thoughts, videos and all that, which was, Facebook and all, which came in that generation. A lot of companies, started to share and, started being very transparent about the data of the customers on both sides, right? And the third generation is where the commerce started to happen. Right? So if you see these organizations, these are all organizations which are startup, fintech, P2P type of organizations, lending companies, which have scaled, and they are all bringing customers on one side to invest, and on the other side, they're bringing customers to, borrow money or to kind of give money, right? So the whole idea of this entire model is that if you have money, you share that money and make money out of it, right? That's what Airbnb did. That's what Uber did. You have a car, you kind of share that car and make money out of it. If you have a house, part of the house is share and kind of make money off it. Similarly, if you have money, you share that money and make money. So this is, this comes under sharing economy. And sharing economy is one of the categories or the markets which is growing exponentially across the world, right? And sharing is now getting, in the retail side, it's getting across various sectors and segments, right? People are sharing their education, people are sharing workspace, jewelry. I know of a company which is sharing their, shadi ka joda. So, people are now sharing that as well. So there's a lot of action happening in the shared economy. So we are a two-sided marketplace in the shared economy. It's important to kind of realize that. Now, why is, this is different? Why
Vinay, sorry, I'm sure you're going to cover, but just to make sure that the audience understands, you are typically in a business where you, in very simple language, have a tech platform where people come and invest money, whoever wants to do, let's say, FD kind of investment, right? You act as a bank and give money at a slightly higher rate to somebody who wants to borrow. That's your business model.
That's right.
Yeah, perfect. Please continue.
Yeah. So now let's understand what's P2P lending, right? So it's a new way of lending, through the shared economy model. It's a new way of lending. Individual people giving money to individual. So what's happening is that in this process, you are eliminating the intermediaries and passing out, the margins and all to the users directly, right? So we don't have branches, P2P lending companies don't have branches. They don't work like any other, banking or a NBFC, large NBFCs that you look at. They're more of a branch-led model. This is a tech-based model. So technology is what is given out to individuals. They come onto this technology platform, and this platform is what, lends them kind of to invest, and also gives them an opportunity to kind of borrow money from this platform. So that's what this new way of lending is. This is today present globally. Started some 15, 18 years back in UK, and today, this is practically across the world, right? You name a country, it's there. The only country that I can name it's not available is Japan. Because the demand supply mismatch isn't there in Japan. That's the reason, credit is fully penetrated in Japan. That's the reason this model does not work in Japan. Otherwise, in most countries, this model works, right? Because there is a demand supply mismatch. Globally, this is the fastest growing, segment in the BFSI segment. This is the fastest growing category. It is exponentially growing at a rate of, 29%. And it's poised to do close to $890 billion of disbursement in 2024. So it's a huge amount and huge growth globally that people are, witnessing in this particular category. We believe that in India also, this will explode. Part of it is already kind of started to move. And the reason is that we are a young population. We are a mobile penetrated, internet penetrated population. We are the second largest internet penetrated population in the world, leaving the US behind. China is number one. Plus, we have a young population. Young people need money. They have money to invest. They need money to borrow. So both is there, right? So there's a huge opportunity there. Plus, India has a great story with respect to technology that we've built, especially in the payments and in the UPI, all of that the stack that we've built is phenomenal, right? So today we are now putting out this technology to close to 50 countries, right? So that's the kind of discussion that India is doing with the rest of the world. So technologically also we are poised beautifully for this to kind of scale, right? And last, I think RBI has regulated this. In 2018, they came out with regulations. So now you cannot do this business without a license from RBI. So RBI has given the first lot, given out some 20 odd licenses, and there are 20 players at this moment, and the top 4 or 5 of them are the ones who are doing actively large scale business. Okay, so quickly, this is what the model is. As I said, it's a platform, and there are two sides. One is the demand side, the other is the supply side. And somewhere in between we sit to manage both these sides. So these are two organizations that we have to manage. So if you look at why I'm saying these two organizations, because the set of customers that you onboard, the technology that you use, the channel that you integrate with, all of it is different, both sides, right? So on the demand side, we bring in large ecosystem or large customer ecosystems. For example, a Bank Bazaar, a Paisa Bazaar, a India Lens, these kind of organizations. Then we have these DSAs, which is another ecosystem which banks and NBFCs had built. I think, for the last 20 years, they've been operating. So we onboard these guys onto our platform. And we get salaried customers, self-employed customers coming directly to us, to kind of get a loan, right? Now, this demand side, all of it is technologically, integrated, right? So for example, even a DSA, we integrate DSAs with technology. We integrate a Paisa Bazaar or Bank Bazaar or any of these large ecosystem players also through technology to bring in the customer seamlessly into our journey. Yeah. And so similarly, on the supply side, we have these large wealth management platforms, fintech companies, wealthtech companies. Then there are these 2 lakh, more than 2 lakh IFAs, independent financial advisors across the country who distribute financial products to their sort of customer, right? So we onboard them. Again, the story is same here. We technologically kind of onboard these guys. Plus, we have direct customers, HNIs, and small NBFCs and institutional lenders, coming and participating in the platform, providing capital. So supply side is the capital side. Demand side is where the loan is given out to, or the borrowing side. And the new thing is in this is the opportunity to invest, right? So that's the supply side. That's a new animal. And if you look at any of these two-sided marketplace, the new thing that they solve is the supply side, right? So demand already exists, and they bring in through technology, they bring in supply so that they are able to kind of meet the existing demand, which could be more than what it exists. For example, Uber, right? So demand for people moving from point A to point B was there. It was just that cheap cabs option was not there, right? So that's the reason Uber had to build the supply side. So similarly, we were going to build the supply side, and that's where the opportunity is for people like you and me, or people who want to invest money. And what is that you're investing on? You're investing on portfolio of loans, right? Portfolio of retail loans. That's the asset class that we are investing. I'm going to talk about that a little in detail, later.
So Vinay, again, I know we spoke on this, but just to make sure, because a lot of these guys may not know demand supply, because
demand is the borrowing side, people who are coming to borrow money, and supplies are people who are coming to kind of, part with their finance or part with their money to make money, right? So that's the investment side.
So the supply side is where people are coming in and investing, saying that give me 8% on a fixed deposit or a 9% on a fixed deposit. And demand is where you are giving these out as loans. If anybody's
so we don't use that word fixed deposits because it's not a fixed deposit. It's a P2P investment, right? So that nomenclature is very important, because fixed deposit gives you a feeling of a secured or an assured kind of and that's the reason the returns are also less, right?
Yeah.
But in this case, this is an investment product, so the returns are also higher, and that's the reason this becomes an investment class or investment product, not a saving product.
Yeah. So let me reiterate. As an HNI, I would invest in a P2P platform. I would get a fixed return on that.
That's right.
And then this money, which is raised from the HNI, is actually lent to people who are looking at borrowing. And the difference between both of these is the platform's income, right? That's largely the one.
That's right. That's
right. Super.
So as we go along, we kind of understand this even better. Okay, so how we do this is, this is entirely technology based and a rule based process, right from customer origination, onboarding of the customer, to appraising the customer, whether the customer is good, bad, ugly, appraising that customer. And once the customer is appraised, operationally, how to ensure that the customer is signing the document, signing the doing the KYC, all of that, all the operation part, all of this is technology enabled. And once that happens, the money moves. Post, the money movement happens. Central part is the money movement part. Let's say, once that money is moved, post that also collecting money every month. Okay, an entire fund flow mechanism, the collection, recovery, all of that is also a whole lot of it is through APIs and tech enabled. And we also have a very large reporting and analytics section, which feeds into all of these, pillars with respect to, conducting this business, right? So it's basically close to 120 APIs across various organizations, government organizations, private organizations, various organizations, basically to evaluate the borrower and make the journey of the borrower seamless. Okay? That's the whole idea of this entire API system. Right? So that's what we do. And this is the IP, and this is what the technology framework is, right?
Awesome.
Okay, so quickly on the regulation, I'll touch upon a few of them just to make sure that one is that we are an online marketplace. Okay, so we're not supposed to do anything offline, right? In the sense we can't be having branches and all that. Right? So that's one. Second is that we cannot lend from our own books or from our own balance sheet. That's not allowed, right? And one of the reasons is very interesting, right? Because lenders said that where is your skin in the game, right? So that's what people normally ask for. But RBI's thinking was completely different. They said that if you are given a chance to lend, you will take out all the good borrowers and push the bad borrowers to the customer, right, or to the end customers or investors. So they didn't want that. So that's the reason that you don't invest. Your biggest risk is the reputation risk. If you're going to do bad borrowers on the platform, you'll have more defaults, and eventually your customers will walk out, right? So it's important that it is you don't lend and the customers only will lend. So we cannot lend from our books. That's one of the regulations. The other thing is that as a platform, we are supposed to underwrite the borrowers, not underwrite, credit assist the borrowers, profile the borrower's risk, do the loan agreements with the borrower and the lender and the borrower. All of that, and service the loans with respect to collection and recovery. All of that is our responsibility. Even filing the legal case, all of that is our responsibility, is what has been given to us. So we, on behalf of the lenders, file the case. We, on behalf of the lenders, do the recovery, send dunning letters. All of that, it's our responsibility.
Yeah.
Apart from that, so the prudential norms, any investor cannot invest more than 50 lakh rupees. That's set by the government. So you can expose yourself once, not more than 50 lakh rupees. The other thing is that no borrower can take more than 10 lakh rupees. Now, all these prudential norms is to kind of ensure that there isn't any large scale systematic issues you get into, right? So or fraud that you get into, or there's a huge loss which gets into. So even if there's a large customer coming in, maximum one can expose is 50 lakh rupees. And also if someone is trying to game the system in my platform, at best he can game is a 10 lakh rupees, right? So it's not a large sums of money. Right? So that's and also no lender can expose his money more than 50,000 rupees to one borrower. That's also norm by the. Okay, so and also the loan tenures cannot be more than 36 months, right? So that you're not giving long-term loans and picking up short-term capital, right? So it's important to kind of have that asset liability, and not a mismatch, right? So it's important to kind of maintain that. So that's the reason these prudential norms have been put out.
Yeah.
The other thing is the money movement, which is the most important thing in this entire regulation piece, I think. Earlier there were depositing NBFCs used to take money into the balance sheet, and some of them disappeared. Some of them used the funds for some other purposes. All of that happened. So RBI had made depositing NBFCs license very difficult, right? So from a regulation standpoint, it's become very, very difficult. So there aren't any depositing NBFCs now being given out as license, right? So this is a new avatar of that, if you ask me. So basically, you're taking public money, but this public money comes in a escrow account or an account which is strictly managed and monitored by a third party, which is a trustee. And and you cannot move the money without the trustees' consent, right? So, for example, if lender gives in the money to kind of lend to, let's say, borrowers, I have to take this money to or this contract and all of that to the trustee. Trustee is the one who instructs the bank. Only then the money moves. So that kind of a control, they have put to ensure that the platform or the people who are operating in the space don't take the money out. So I don't, as an organization, we don't have any power to take this money. We don't have any checkbooks. We just have the viewing rights. That's it. So it's completely controlled by the government. And it's a very foolproof system, right? So there were some issues in the past where they have seen a simple escrow account also can get into a riskier zone. In somewhere in globally they had I think somewhere in Middle East, bank and the real estate company got together and swindled public money from the escrow account, right? So escrow account has been around for some time. It's just that a trustee sitting on that escrow account and making a decision, and instructing the bank is the phenomena that I think has got introduced in the P2P lending platform. So what it means is that even if we go out of business, right, your money is not going anywhere because this money comes into this ecosystem, a secure system, managed and controlled by the government, and from there it goes to the borrower, and all the borrower's NAC or the repayment is stitched to this particular account. It comes back to this particular account, and the repayment also happens to the lenders from this account. So it's a foolproof thing that they have made this time, and also possible because of the technology.
Sorry, just to make it more simpler, then how does FairSent as a platform remove profits from the escrow account?
Yeah, so that also has to be in the agreement.
Okay.
So you cannot. So the trustee will transfer your money, or instruct to kind of transfer that money from whatever that margin is to kind of one to us. So sure. All of that is driven by the contract.
Okay, got you.
And the trustee has a lot of rights, right? They have the right to inspect, audit, all of that is there. They can come and shut our business like today, right? So they'll stop dispersing. They'll start, in giving instructions to the bank, my business will shut, right? So it's that powerful, right? So you can't be fooling around with whatever that you're doing, right? You have to be very careful. And trustee is not, very few licenses if you're not trustee. Mostly banks are trustees, and there are very few trustees otherwise, right? So government does not give out trustee licenses to everyone and everyone. So what they can believe and depend on, they give out licenses. The banks, large banks, not even small banks, large banks have trusteeship license.
So Vinay, who's your trustee? ICICI?
ICICI is not trustee. It was earlier IDBI. Now it's ICICI. Okay. ICICI is more technologically advanced, so that's the reason we can move by. Oh. Okay, so overall, what is the asset that we are talking about? So this is an investment class, and you're wanting to invest, or you're thinking to invest. So the fundamental thing that you understand before you invest in any investment, right? So you have to understand what is the underlying asset, right? What is it that your money is going? What is it that it's getting put to? Only if it is put to good use can it kind of get your money back, or the money can grow, right? So what is the asset? So for us, this is basically portfolio of retail loans. Okay, and it's a very powerful, asset class. Okay? It's a very powerful asset class. Okay. Now, if you look at it from literally from a customer's standpoint, you never got an opportunity to invest in retail loans. Okay. Banks and NBFCs have been enjoying this for the donkeys of years, right? For the last 20, 25 years, they've been enjoying this. More than 25 years, they've been enjoying this. And if you look at any decent, large-sized bank or NBFC, they've been booking profits quarter on quarter, every quarter, right? So, and they've been growing phenomenally. And that's because they have built, and most of them who become big and who have been still around are the ones who have retail loans. Right. For example, HDFC, ICICI, Axis, SBI, Bajaj, all these guys have become very big primarily because they have done retail. So the asset quality class is fantastic, right? So there's no doubt about that. Retail assets perform better than institutional loans, right? Retail loans perform better than institutional loans. Most of the defaults that you hear of, or the NPAs that you hear of, are all retail. It's all institutional. They're not retail. Retail, defaults are very less compared to the institutional ones, because what happens is that when you put in large chunks of money with very few limited number of customers, your business model itself is a little, scary, right? So that's what happened with Yes Bank. A lot of money chasing some 800, 900 companies, right? So if some of those companies, 20, 30% of the companies stop doing good business, then your entire bank is under threat, right? That's what happened with Yes.
Yeah.
So it's important to realize that, this is a retail loan. Look at SDFC, right? It's kind of distributed itself to so many, retail customers. So their portfolio, the balance sheet looks very, very solid in spite of COVID or whatever, right? So, and that's what we are trying to kind of talk.
So basically, we are saying that when I invest in your product or give you money, basically that money is given out to small retail individuals as well.
That's right. That's right. Now, also to understand is that, who are these retail investors or retail, customers that I'm giving out money to? Okay. So there are different models. Some of them focus on salary customers. Some of them focus on small businesses, right? So this is the product that we have to offer. And it's not that we didn't do salary. We did salary over a period of time. We realized that small businesses are better customer sets than salaried, and that's the reason we kind of moved to this. So I'm going to talk about that. So the offering that we have is a 12%, 11%, 10% return that you're going to get on investments that you're going to make. There are also monthly investment schemes as well, 10.5 and 10%, where you give the interest, where you give the principal and you get monthly interest on this. And there's also something called Freedom Plan, which is there is no commitment, whereas in the fixed plans, there is a 12 months, 6 months, and 3 months commitment. In the Freedom Plan, there is no commitment. You can put the money and take the money whenever you want, right? So that's the opportunity, but you get only 8.25. Whereas if you put it in 12 months, you get 12%. You put it in 3 months, you get 10%. If you put it in 6 months, you get 11%. Now, where do we, give this money to? This money is given out to small businesses across the country. 85% of our money goes to small businesses, sole proprietors across the country. And we take a look at a long-term view with respect to borrowers. We don't take a short-term. Okay? We have to look at least a 3-year horizon. Can I, when I look at the borrower, can this borrower pay me for 3 years? Next 3 years? If I get an answer, yes, I might go and, fund this guy, right? But how do I get that answer? It's only when I look at 3 years of data in the bureau, right? So if there is a 3-year data, a 3-year vintage data in the bureau, can I take a view of 3 years that this guy can give me EMI? So a long-term view of a credit view of a borrower of 3 years can only be taken if you have a 3-year vintage or 3-year data vintage in the bureau. Otherwise, you will not be able. So if there are only 2 months or 3 months, I can't give him a 3-year, right? So it's important to understand this, because this is where the asset differentiation is, right? So there are a lot of people who are doing short-term loans, right? Small ticket loans. They don't have a view of long-term with those borrowers. They have a short-term view of that. That's the reason they're giving short-term. They are subject to high risk, all of that, high price and all. But I'm not going to get into all of that. But I want to think our view is that long-term. We look at customers long-term, and we look at long-term vintage with respect to customers, at least 3 years vintage with the customers' data before we lend.
So Vinay, help me understand if I've understood it well. And second, I'm going to ask a question with respect to the viewers, because a lot of these guys would not know what a bureau is, right? So let's say we are saying that you typically, even if somebody comes onto your platform to take a 3-month loan, you would still look at a 3-year vintage before giving a 3-month loan.
That's right. Okay. So the moment you are going to, if someone is going to come asking for 3 months loan, in 99.9% chance, he may not have a 3 years vintage.
Correct.
So those customers won't come to us, right? Or if they come, they will not get it.
Okay, awesome. Another thing to understand here is that, of course, I would want you to spend some time and help us understand what is this bureau, because a lot of people watching this may not know. But from another context, let's say if I don't run a home loan or a personal loan, if I've not taken a loan at all, does that mean that I don't have any history, and hence you would not lend me?
Correct. I will not lend you.
Okay. So even if I'm a good customer who's never never had the need for a home loan or a personal loan, this becomes a negative for lending on the platform, because you don't have a history whether I pay or not, right?
That's right. That's right. So basically, we did a lot of new to credit customers earlier, okay, who have not taken a loan in the past. Their defaults are significantly higher than people who already taken a loan and have performed on the platform, on the bureau. Right? Bureau is nothing but credit bureau. Today, the government has made mandatory for all banks and NBFCs to report data of the performance of the borrowers to bureau, and there are 4 bureaus in the country, and you have to give the data back to all these 4 bureaus, and it is mandatory for all of us to kind of report that data. And the reason for that is that if you don't report, it can be a systematic risk. So a large pool of borrowers moving around and taking money from different NBFCs could get into some other problems, right? So we don't want to kind of have that. So all of them are mandatorily reporting the data, and it's good for the industry. And if you kind of don't pay to one NBFC, I get to know, and you will not get a loan from any of us. That's the way it works.
So Vinay, if I have to just sum it up for the viewers, and correct me if I've understood this well. So when a borrower comes onto the platform to borrow money, right, what you typically do is look at 3 years of history, whether this guy over the last 3 years has taken a home loan or runs a home loan or a personal loan or any other loan, and how well has this guy been able to service those loans.
That's right.
You get this, and you get this data from the bureau, where all the banks and NBFCs report. So at a click of a button, you would understand that this new guy who's come onto your platform to borrow money, what has been his or her history in terms of repayment of the loans that you've taken.
Correct.
And if this guy or this lady is not taken a loan, and hence there is no history, right? You assume that, and the data that you spoke of, that this is even more riskier because these guys default more, you all don't lend to them. Have I summed up this slide correctly?
Yes, absolutely. Absolutely.
Awesome. Super. Thanks.
So one is the long-term view that you look at, for borrowers. Second is that we don't have any concentration risk because of this reason, right? We cut across India, different segment, different industry, different types, because these are all small, retail businesses, right? So there are close to 70 odd million small businesses in the country, employing close to 150 million people. And there is a lot of value that you can create in that segment. That this is the second largest employing segment after agriculture. A lot of dependency of the nation is in this segment, and that's the reason we are going after this segment. And we feel that it is important to fund people within the segment, because today's small business is what becomes a larger business tomorrow, right? So employment, all of that is stitched to that, right? Yeah. So that's the reason I think it's important to put money in this asset class. As an organization, we decided that. Now the question is that why is it that we are just doing 15% of salaried borrowers? What we realized is that over a period of time, so this is the investment, the small business investment. This is small. What we realized in small businesses is a better asset class than the salaried employees, which is not covered by the banks, right? So typically what happens, a salaried customer gets covered by the bank. Okay? So if you have a small organization with 40, 50 member team, a bank employee will come and propose a CASA relationship, right? A current account to the owner of the company, and a savings account to the employees, right? And he will offer a credit card along with it, or a debit card along with it. And with that data, he is able to kind of predict who are the customers that he can offer a personal loan, which are the customer they can offer a bike loan or a car loan or home loan, and it goes on. So there is a lifetime journey the banks are able to pick up early on with these organizations, and they're cut across small cities, small, even rural areas. So they are pretty much well spread. The banks branches across the country. So for them, it's easy to kind of do this, because salaried customers, the salary is the denominating factor, right? That's a if you're getting paid, if you are working in an organization which looks okay, they're able to kind of fund you, right? But the ones which gets left behind, okay, are the ones typically who come onto our platform, right? P2P lending platform. That's the second choice for them, right? So there, early on when we saw this particular segment, their performance was not very good, right? Especially during COVID, we saw a lot of them lose their jobs and all that. So over a period of time, we realized that small businesses are better asset class compared to a salaried segment, right? And there is a fundamental difference also between the two. We've realized is that small business, have more data, okay, compared to salary, right? So they have banking data, they have bureau data. Bureau is the credit, civil data. Then they have GST data, they have transaction data. If they are using some, Paytm or any of those, GPay or any of these phone pay apps. Then they have ITR data. All of this data helps us predict better. With salaried customers, the only data that you get is the salary getting credited, right? So there isn't much data. Then the next side data is all consumption data. खर्चा दिखता है, income वाला एक ही data दिखता है.
So on sole proprietor, you are saying that either you ask all of these data from these guys when they are asking you for a loan, or you pick it up from the APIs that you talk about.
All of it is get picked up from the APIs. Today, banking is also opened up. Bureau is anyways open. GST data is also open. Transaction data, take a permission and you can get this data. ITR is also open. All this data is third-party data that we get. He just has to kind of validate. The customer has to come and give us basic details, and we are able to kind of pick up all these details.
Oh wow! So you can pull his banking data as well, right?
Yeah, I'll talk about that. How this works. Yeah, banking also opened up now through account aggregators. Now all the banks have come together to kind of share data amongst each other. So if I need customers' data, customer has to give me just access. Which all bank data he needs to expose it to me. If he gives me the consent, I can just pick up the data through account aggregators. Okay. The other thing that we've seen is that over the last 10 years of at least our working in the segment in this industry, the sole proprietors defaults are lesser than the salaried customers. I'll demonstrate that to you by one metric, right, in my subsequent slides. The other very interesting thing is that the movement is very restricted. In a salaried customer, what we've seen at least in the past, not now, people used to change their phone numbers. Okay, when they move to one city to another city, the address used to get changed from one city to another city. Location, okay, the bank account used to get changed. The new employer used to give him a new bank. Yeah. So all of this change used to kind of limit the collection process, right? Not that I'm doubting that the person will have an intention not to pay. It's just that he didn't also have the intention to kind of call back and say that, boss, my credentials have changed now. Please update it. He'll not do that, right? So because of that, collection used to kind of delay, and any collection delay results in higher default. So, but if you look at the small businesses, all of this is like so important for them because that becomes a linkage for them to kind of conduct business. They can't change their phone number, they can't change their address, they can't change their bank accounts. All of that is so important for them. So the movement is very, very limited, practically not there. So that's the other reason. We've also seen, I talked about a good salaried customer gets locked up by the banks because banks see a lifetime value in that. And they don't do with small businesses because to compute a banking and a bureau and a GST, all of that, to give a small loan of 2 lakh rupees or 3 lakh rupees doesn't make sense for banks. Okay? And small businesses don't have this relayed, timeline kind of a lending cycle, right? Bike loan, then car loan, then home loan, consumer loans, all of that they don't have, right? So they'll typically borrow for life events. Okay, for example, bachchi ki shaadi karani, yeah, extension of their office, right? So they will pick up money for life events. Otherwise, they won't pick up money, right? So they are able to kind of conduct their whatever day to day with their cash flows, right? But salaried customers don't behave like that. Their behavior is they spend money on life experiences. So there is a very unique anecdote on HDFC Bank. HDFC Bank early on never lent money to people who were wanting to buy a Harley Davidson, but they would lend money to people who want to buy a Bajaj or a Hero Honda. Oh, because it's attributes to going to office, generating income, and that's the reason. And the other one attributed to more of lifestyle and more of So today, most of the salaried customers are doing a lot of lifestyle. I'm not saying that it's wrong or right, but I'm saying it's a better asset to invest in life events than on lifestyle expenses, right? So Also, we feel that globally, what has happened is that if you're investing in P2P lending platforms in small businesses, okay, UK government has passed a law where the income that you make out of that, let's say the interest income that you make out of that, it's tax free. Okay, and also if you make any losses, you can adjust that losses against that your income, right? So that's the law they passed some 5-6 years back. This law will come to India as well. Okay, because it makes a lot of sense for the government to aid these small businesses, because the small businesses are the ones who bring in a lot of employment, okay, a lot of growth, a lot of consumption, a lot of this thing is dependent on, and that's the reason a lot of focus is around there. And there was a paper, white paper table, where government is seriously thinking of moving. Remember that Mudra money that government had introduced through microfinance companies that didn't see the light of the day. So they are wanting P2P lending companies to kind of move this through their network or through their channel, right? So those kind of discussions are happening. Yeah, we are actively discussing with SIDBI also. Is there a way that we can lend to these small businesses, right? So the government, bring in their capital. So the UK, the way it's happened is that 50% of the money, public, money goes to the, borrower, 50% government contributes. And this is the first time UK government has made money through lending. So these kind of, and all of this is because, the platform is very, very transparent. We're able to kind of give all the data, all of that is there, publicly, you kind of showcase all of that. So that it becomes easier.
Vinay, currently, just to clarify, in India, the interest income that I make from my P2P lending is marginal taxed, right?
Taxable, yeah. It's taxable right now, but the law is not there in India right now. I think, in future it will come up. And we've kind of spoken to government about it, and they're very excited.
Sure. Interesting.
Okay, so I was talking about a metric that I wanted to kind of share.
Yeah.
Now, this is a very interesting metric. All NBFCs and banks track. Okay, this is a metric on non-starters. Non-starters are the guys who don't pay even a single EMI.
Oh.
Okay. They will kind of disappear. So these are, these contribute 50 to 60% of the default. The rest default is people who have either got into some medical problem, or their businesses have shut shop, or they have lost their jobs or something like that, right? So apart from these two reasons, the people who run away, who don't want to pay, are the ones who are called non-starters. So if you look at this data, in spite of COVID, all of that, salaried non-starter is 3.82%. And self-employed non-starter is 1.36%. Overall, weighted average is down to 1.7 because of this self-employed, we do 85%. That's the reason it's kind of, brings it down. But if you look at COVID, around COVID, look at the non-starter which climbed up. But that's not the same behavior that we saw in the self-employed. So just to kind of
this is your data, right?
Yeah, this is the data that we have lent to, and this is not a small amount of data. Large amount of this. We've done close to 5,000 crores of disbursement. So this is the data which is and what you're seeing right now is more than 1,000 crore data. October, maybe 1,200.
Nice. Interesting.
Last 3 years data, yeah.
Interesting.
Okay, so let me just take you through how the process is. We're going to go a little more deeper in how the process works. So it's important to understand because, as I said, we have two sides. One is the lending side, the borrowing side. The actual evaluation happens on the borrowing side, right? That's where the entire technology, all of that sits, right? So the sourcing of the customers or the borrowers happens through a lot of partners, as I was talking about. So these are DSA partners. They are large aggregators. There are ecosystem players and all that. They are the ones who bring in the borrowers to us. We have many of them. We're tied close to 2,000 of them who bring in borrowers to us. All of them we have technology enabled. Once the customer is put to us, okay. So what we do is that we give a digital screen to all these partners of ours, and they either them or the customers have to kind of put out their details. And once the details are captured, we try and establish the identity of that particular customer. Now, what is it that the customer gives out is his name, his date of birth, his PAN card, his address, PIN code, and his mobile number. 5 data points. That's it. And everybody remembers these data points. With this 5 data points, I'm able to evaluate the customer.
Oh, wow.
That 5 data point goes to the bureau. Okay. An automated bureau check happens. Whether I have to take this customer forward or not, happens at the bureau, a decision is made whether the customer journey moves to the second line that you see, the rule engine, is the journey where my journey starts. Okay, most of the automated, credit bureau checks, we host at partners end itself, right? So the evaluation happens at their end, and from there we get to know who to get and who not to get into our journey. I'm going to talk about this automated bureau check in a while. Okay, what is it that we check, okay, before the customer gets it? 85% of the customer gets knocked off in this stage. Okay, now,
and that is because they don't have a history. Plus, they might have.
Yeah, many reasons, right? There are some 15 reasons. I'm going to highlight some of them, right? Once that happens, the customer comes to our, journey. Let's say 100 customer starts, 15 of them come to our journey. Now we have a rule engine, and this rule engine is a mature rule engine of the last 10 years of data history and learning. It's a machine learning rule engine, which technically what it does is that any borrower who is not performing, it kind of tells you that this borrower is not performing. Any borrower which is performing, it tells you. So basically, the segment or the sets of borrowers not performing, you'll price it higher, and the sets of borrowers are performing, you'll kind of start to price it lower, right? So it's a risk-based priced rule engine. Okay. So what it does is that it tells you how much money that I can lend, what is the rate of interest, and what is the tenure. Okay, that's what this job is. Once that throws out, it comes to the underwriter. Underwriters are the people underwriters or risk assessment people. We don't call them underwriters, we call them risk assessors, the risk team. So they basically check the affordability assessment, banking, GST, all of that data, all the data sets that so that data set is again pulled by, APIs, and we get all this, banking data, GST data, all of that data we get. Once we understand whether he can, pay the EMI, he has enough balance, he has enough cash flows, all of that assessment happens, only then it kind of moves to the next level of personal discussion. Now, this part is technology, affordability, banking, and all that happens to tech. Then there is a personal discussion which happens. This is basically to ensure that the customer that you're talking to is a customer, right? It's not a bot, right? So it's important to you can't have the entire thing, automated, right? So you talk to the person, and also they are experienced, risk assessors. They understand what is the requirement for, and they ask some pointed questions. What is the requirement for? Why do you need the money for? And if they're saying they want to extend the office, what is the office? What is the extension for? When is who are you giving the contract to? So they'll ask series of questions. If you fumble and all that, if you feel any doubt so they may decide not to give, right? So they knock off close to 50% of them for, because of banking and for affordability. So 7 of them, remain. Okay. And then they decide, and a final decision is taken for credit to be given. Okay. Once that happens, it moves through the operation team. The last line is the operations line, right? Operation team will do a video verification. It's a face matching technology. So they match the video of the customer, a selfie image of the customer, with the data they picked up in identity establishment, the first line. So Aadhaar data or a PAN data, you have a picture of yours. That picture is matched with this particular video verification. So the selfie and if there is a, more than 70% match, the customer goes through. 65-70% match, the customer goes through. Otherwise, the customer gets dropped. Okay. If it is more than 90% or 95%, then there is a conversation which happens, because you can't have your Aadhaar or a picture matched to your selfie 100%, right? So there could be a case of fraud. That's the reason there is a conversation which happens. If there is any, otherwise it goes through. Then there is an ENAC process which happens where he has to set up his NAC. NAC is nothing but a check, electronic way to kind of collect money. It has the power of a check itself. You don't pay ENAC, it's equivalent to criminal offense, right? So section 138 gets applied. So we do that setup, and once that setup happens, a digital signature is taken in the agreement, which is an e-agreement, and once that happens, we disperse the money. But before we disperse the money, we do a penny drop. Penny drop is to get the data of the customer, is to identify whether the customer who started the journey is the one who are giving the money, right? Because what we've seen in the past is that if the husband's bureau is bad, husband will ask the wife to kind of start the process and get the money in a let's say a joint account.
Oh,
you know what I'm saying? Just to avoid that, if you see a joint account or if you see anybody husband's account, we don't disburse. So if there is a joint account, the other guy also has to apply. Together, their bureau has to be looked at. All of that happens, right? So,
just to make it more relevant to the audience, because this is the common discussion around CIBIL score, right? What kind of CIBIL score do we generally lend to?
So anything which is upward of 650, we don't look at CIBIL score, we look at CRIF score, which is more stringent than CIBIL. So from CIBIL point of view, it could be, I think, 700 plus.
Okay, got you.
Average is around 750, 760 plus.
Oh, interesting. 750 is brilliant.
Yeah. See, but CIBIL score does not give you the right picture.
Yeah. No, I'm just trying to context it with the general discussion that people have.
A lot of people would have a great score, but they will default eventually, as you go along. So there are other data points that you look at for the last 3 years to figure out whether we should take this guy or not. So I'm going to talk.
Sure. Very interesting. Yeah.
Okay, so these are the hard exclusions that I was talking about earlier. This one, automated bureau check that I was saying. This is the automated bureau check. So these we call it hard exclusion. They get knocked off. 85% of the customer gets knocked off in this stage, I said. So one, we don't give it to anybody who is new to credit. Okay, we stopped after COVID.
Yeah,
we don't. We don't give it to any borrower who is defaulted in the past.
Sure.
Okay. Even 20 years back, if he's defaulted, we don't give. Any borrower who is currently delinquent, so he's not defaulted, he's currently delinquent, we don't give it to him. Okay, any borrower who has got less bureau vintage.
Could you explain the third point a little more? What do you mean when you say delinquent?
Delinquent are the guys who have not paid money. Whatever is due is not paid.
So even if that's one EMI.
Yeah. So, what I'm saying is that current delinquency means that he's just moved to 90 days right now.
Okay, the normal NPA rule. Yeah.
So he's not a defaulted guy. Let's say उसने 90 day के 180 के भी पार कर गया और नहीं दिया पैसा. So there are people who even after 90 days they come back and pay back.
Yeah.
Okay, they are called delinquent guys. Okay. Defaulters are those guys who don't pay.
Correct.
So we don't give it to anybody, and we don't give it to guys who are currently delinquent. So, for example, if he is delinquent in the past, last year he was delinquent and he's paid the money back, we give it to them.
Okay.
But current delinquency,
someone
is delinquent right now, we don't give. 6 महीने के अंदर या साल भर के अंदर किसी ने क्या नहीं देना. Borrowers who have lesser vintage, less than 3 years for business and lesser than 2 years in salary, we don't give. Any borrower who has great history, great record, great score, has never defaulted in the past, never been delinquent, has a great bureau vintage, but he's credit hungry. In the sense he is, shopping around various PFCs and banks for a loan.
Sure.
So वो दिख जाता है bureau में.
Yeah.
He has applied for so many banks and NBFCs to get a loan.
Yeah, which is why they keep saying that don't give your application to a lot of people, because when
that's right.
Bureau check.
Credit hungry borrowers are typically those borrowers who are wanting to take the money and pay to somebody else. So anyways, it's not going to be used for the purpose that lending is supposed to be for.
Yeah.
Chances are that he will not pay you eventually after some time. Right?
Yeah.
So it's important to and also we don't onboard any borrowers who have delayed their payments, more than 30 days in the last 12 months.
Okay.
This is not delinquent guys. These are delays. So 90 days के ऊपर नहीं हुआ है. ये 30 days के ऊपर हुआ, उनको भी नहीं दे. 30 दिन के ऊपर अगर किसी ने भी अगर delay किया है, last 12 months में we don't want. So all of these guys would have a great score.
Yeah. Okay.
But we knock off these guys, because these are the potential guys who will eventually default.
But I mean, just a devil's advocate again here. Let's say if in the last 24 months and prior to my last 12 months, if I was a delinquent, how is that?
If you're delinquent and if you're paid back, then I will give you loan.
But how is that a superior one than a 30-day delayed? But
because this is current. Because this is current.
Okay. So you're saying that probably things might have changed over the last 24 months, and that guy is much better than the last 30 days.
That's right.
Okay, got it.
So current का बहुत जरूरी है, क्योंकि current में performance कैसा होने वाला है, that is what is going to determine the future, right? Your payment, which is going to happen in the next few months, is a reflection of what your what situation you are in right now.
Sure.
Okay, this is something very interesting that we do. Okay, nobody else does this, right? So this is the prioritizing of the borrowers. Okay, so we get the supply from the the investing or the lenders, right? And there is a demand which comes to us. We have to kind of give out the supply to the demand. After the bureau check, all of that, the customer who comes into our journey. Okay, the first set of customers that we prioritize, this is all system driven, are the ones who have a home loan or a LAP and have service 24 months without any default. Default का check पहले हो गया है. तो first home loan और LAP वालों जिन्होंने 24 months. Second priority मिलता है people who have taken a personal loan or a business and paid off 25% of the loan. Third priority is given to people who have taken an auto loan and have paid 24%, 24 months. And fourth is credit card. 12 months clean repayment, right? Served for 12 months. उसके बाद का priority कम हो जाता है, उसके बाद फिर खत्म ही हो जाते हैं basically. That's the reason it's shown in dim. It's consumer loans actually. Okay. 6 months. And there are other, if there are any other gold loan, other trade lines. But majority of our money gets exhausted in the first three.
So the left hand side numbers that you are pointing at 15.3 and 54% is your book lending to.
That's right. This is just to kind of showcase, but majority of them gets fulfilled in the first top three.
So basically, your largest lending or book is to somebody who's taken a personal loan or a business loan.
No, not auto loan.
25% of that loan.
That's right. Because as I said, we look at customer with 3-year vintage. You have to have a 3-year data. So obviously, those sort of customer would have some kind of a history, right?
Sure, so, makes sense.
So we pick up quality small business customers.
Sure, got you.
तो हम लोग वो छोटा लोन उस टाइप का लोन सब नहीं करते हैं क्योंकि दे आर हाई रिस्क बिकॉज वी सीन दैट वी हैव डन दैट इन द पास्ट वी सीन दैट सब्जेक्ट टू लॉट ऑफ रिस्क राइट डिफॉल्ट उसमें बहुत ज्यादा बैठता है people disappear all of that happens especially in the salaried sector so there are a lot of learnings there we could take a different session altogether to kind of make okay so this is the performance how the portfolio is performed so more or less all of us report like this. So important thing to realize is that this business will have default.
Yeah.
It will not run without default. Second thing is that you cannot write off. As a business, I cannot write off. So if you see this default climbing, it's because it is cumulative.
Okay. Yeah.
It's cumulative. So RBI does not give us this thing to write off. But the gross return that I make and the net return that I make, difference of this is the default. And this is the margin of
default, the actual default.
Yeah, this is the margin of safety. The green line, the dark green line is the net return. The dotted blue line is the gross return. And between is what the default is, right? And if you see the margin of safety, it's close around 10%. What it means is that my lending rate is, let's say, 9%. Or let's say 10%. And I'm lending at 22%. Okay, I'm making an average this thing of let's say 20% or 22%, 18%. I have a 10% spread. What it means is that if I do defaults 200%, still I will not breach the. If I do 300%, I might touch the 9% mark. If I do some 500% is when I shave off some of the interest. Your principal is still protected and safe, right? So this is why lending is very powerful. If you build out scale, it's very difficult to tootna mushkil hai bahut, because you can't have so many people decide one day in the morning not to pay money, right? So because this has a legal, it is backed by contract, right? It has legal implications, right? Nobody wants a court notice coming to their house, right? So it's important to kind of or a collection agent coming to their house. So it's important for them to pay that. So आम आदमी की फितरत खराब नहीं होती, वो पैसा लेता है, पैसा दे देता है. होते हैं कुछ लोग बदमाश 1-2%, which I talked about earlier, and that is a part and parcel of this.
Vinay, correct me if I've understood this slide of yours correctly. The yellow line is showing that your borrowing cost is roughly slightly upwards of 8%.
That's right. That's right.
You've been lending it roughly at, let's say, 22.89%, which is the gross return that you've shown. Yeah. Right? But because there are NPAs, what you roughly make net, which is the dark green line, is roughly close to 18-19%. And
That's
hence
right.
you are saying that you're borrowing from the market at 8-9% and making 18-19% after the NPAs, and hence you are making 10% margin on this business. Have I understood this well?
That's right. That's right.
Right. And so you are saying that even if the default rates are extremely high, right? I mean, the default rates will have to be extremely high because you're making 10%.
Yeah. So even if I double it, it'll not impact. If I triple it, it'll not. Even if I do 4 times, is when it'll touch it. 5 times is when I breach. So
Can
it's
you
not possible. Technically, it's
throw
not
some more light on how is your NPA reporting, which you said, which is cumulative, different from how banks report?
So what banks do is that, for example, आज इस साल का जो default है, साल भर होने के बाद write off कर देते हैं.
Correct.
Right? We don't do that. We're not supposed to do that because lenders' money. We're not lending from our books, right?
Correct.
So banks NPA will always be 2%. Okay, but we'll have to carry on our this thing, NPAs all along. We can't write them off.
So when will this taper off? Because at some point in time, let's say today, what I see here is it's close to 3.8, 3.7.
No, the lending is also growing, na? So lending also keeps growing.
Okay, okay, got you.
So I'll give you another this thing, right? So the money that we bring in, it's 12 months. Okay.
Yeah.
So let's say, for example, you're bringing in a lakh rupees for 12 months and it's locked for, let's say, 12 months, and I give 1,12,000 rupees at the end of the year, right?
Okay.
So this money that I bring in, let's say 100 crores I bring in of similar kind, 12%, I lend this money to these borrowers. These borrowers' tenure is 2.5 years.
Sure.
I make money at 22% for 2.5 years.
Yeah.
Right? ये इसी को annuity income कहते हैं, lending business. Right? And this is the most beautiful part about lending, right? So this annuity income, so my income from that borrower, the first year what I make, I give to my lenders. The second year and the third year, what I make is coming to the portfolio.
Correct.
Right? So even if I have a default in the second year, okay, the portfolio takes care of it primarily because there is more money that we make subsequently than whatever that our commitment is towards the lend. Right? And the new set of lenders keep coming and the loan contract gets renewed, with the new set of lenders. So for example, 3 साल short term में मेरे को पता नहीं कैसे होता है, लेकिन हमारा ऐसा चलता है जैसे 3 साल का हमने किसी के लोन किया. So आपने 1 साल का पैसा लगाया, तो 1 साल के बाद आपने सब अपना पैसा विड्रॉ कर लिया, तो आपकी जगह वो लोन कॉन्ट्रैक्ट जो है ना दूसरे लेंडर के साथ साइन हो जाएगा जिसने पैसा लगा रखा.
Sure.
That's what keeps happening. In a shorter term, I don't know how people are doing it, because if you're contracted with a particular borrower who is 3 months, and if you have given out money for 12 months, 3 months gets over, the loan contract gets over, do you sign another loan agreement? I don't know whether the other platforms are doing this or not. Or you cannot have a contract with a perpetual agreement, right? Perpetual signing. That's not possible. As per law, it's not, you're not going to do a perpetual one, right? So you have to kind of do the contract right now. So we do it, a new contract with the new lenders for that particular borrower. That's how the journey continues. If there is a prepayment happens, we kind of close that loan and kind of give the lender money back, and it kind of comes back again to the pool, and he can invest again. So that's what.
I have 2 questions from my viewers' point of view. While I understand both of these, but I still want to ask you. So the cumulative NPA that you spoke of, because you all can't write off like a bank does.
Yeah.
Is there a point where your NPA at any point in time tapers down, or it only keeps going?
No, so it can taper down if you do large lending.
Large lending.
So अगर इस महीने में ज़्यादा कर दूंगा तो taper हो जाएगा थोड़ा सा. But eventually it will kind of, over a period of time, I think it should grow. It'll only go up if you're not writing it off, right? So you have to kind of show it in that book.
But isn't this not then showing the right picture? Because at some point in time, if you start showing me an 8% NPA, I might get scared.
Yeah, you're right. But the loans get over, right?
Yeah.
When the loan gets over, you take them off.
Okay.
3 साल का 2.5 साल का लोन तो वो तो निकल जाता.
Sure.
Long term में तो वो उतना ज़्यादा नहीं जाएगा जैसे आप बोल रहे हैं ना, उतना नहीं. This is a 3-year portfolio. That what you're seeing right now is a 3-year portfolio.
Yeah.
So the loans, average loans are around 2.25 or 2.5 years. No, 2.5 भी नहीं है. 24 to 28 months. 28 months to be precise is the loan tenure. So after 28 months, anyways, all these loans are going to go away. It will not perform. So we'll only take those loans which are in the book at that point in time.
Okay, got
Which
you.
is a fair way of showing, right?
Yeah.
People are writing off and showing, which is a wrong representation. We ask, right? It's not. So showing the NPA at a very low, it's not right. You can't have an NPA of 0.5% or 1% when an HDFC is having an NPA of 2.5%, ICICI is having an SDFC of 3%.
Yeah.
On a retail book, which is home loan, all of that put together. The RBI का data बोल रहा हूँ.
Yeah.
कुछ data है. 2022 March का data है. So you can't have a 0.5% NPA, right? So that means you're not representing it right. Now, a lot of people are trying to show it in a very different way. For example, NPA definition, by definition, is only 90 days plus,
Correct.
right? Now, if your loan tenure, most of the loans that you're doing is less than 3 months, you're technically not reporting anything. Either your loan tenure gets over, or you get the money or don't get the money. So you are not showing. So those kind of, so we don't do any of that. So ours is a very clean and a very transparent way of showing it. We say that this is the 3-year loan or a 2.5-year loan that we give out to people. And this is the performance, and NPA is cumulative over a period of time because you can't write off. RBI has not given us this thing to write it off. So we show the NPA as it is.
This is such an interesting discussion because I, very honestly, most of the question that I asked you, I knew the answer for, but I was asking for my community. But I didn't know that this was cumulative and you all could not write off. So
yeah,
very interesting learning.
How can you write off? It's lender's money, right?
Yeah.
Money kitab mein to nahi hai. So a lot of people are doing that, but that's not the right representation.
Very interesting.
हमारा NPA ज़्यादा है, competition ज़्यादा है, बोले कि that's the way it is, right? So whatever is to be done, the right way has to be done.
Vinay, one last question. I mean, again, from a risk management standpoint, how do you all manage ALM? I mean, what part of your
very good question? Very good question. So I'll tell you what. So the way that we manage ALM is that if you look at the data, when we started, our cost of funds was very high. That's because we started with 12%.
Sorry, just give me a moment for everybody. I mean, what I'm trying to ask him is that if, let's say, if he's borrowing money from the market for 12 months and lending for 36 months, there is a mismatch, right?
That's right.
At the end of the 12th month, he has to give money back to the person who's invested. But he's given loan to somebody for 36 months. Then how is he managing it is the question. That's called ALM. Asset liability.
Yeah. So if you look at when we started, our cost of fund was, cost of fund was around 12%.
Yeah, that's just visible.
ये 2% नहीं है, ये 12% है. 12, 16, 20, 24, 28 है. Sorry about this. So currently it is around, just a little above 8%, right? 8.45 or something.
Yeah.
Now, when we started, it was 12% because we started with 12-month product only. We didn't introduce the, freedom product or, the one which gives you the flexibility of taking the money and taking it, right? So, and then we introduced the 6 months and 3 months, and eventually we introduced after, a year or so, we introduced the freedom plan. And that's the reason I think this cost of fund also has come down. The natural choice of the customer is to put in freedom. Okay. But what we do is that we don't encourage our sales team and our channels to get us freedom money. So our money in freedom is very little. It's only 18%. And we back that with, a 10%, what do you call, 10% reserve.
Liquid money, basically.
10% reserve we maintain in the escrow. If there is anybody, 18% में से कोई आ जाता है, तो the highest that we have seen is during COVID, that went to 11%, right? So if there is people, in a growing economy, if everything is going, people don't really want to kind of come back. Large number of people won't come back and ask for money, right? Unless there is some bad news which comes around and people want to kind of get the money out. But otherwise, typically people invest and stay put. So we don't incentivize. The moment the customer brings in money in liquid, we push the customer to kind of put it in fixed plan. Now, why we do it in fixed plan is because at least we have 3 months or 6 months or 12 months to kind of give the money back, right? And ye chalti kitab hai. This is a book which is an asset which can be sold off in the market, right? So and also the good part about at least our business is that the investors that we have, the people who are on our cap table, are the banks and NBFCs. We have ICICI Bank, GM Financial, Muthoot, all these guys are on our cap table. So if in case if there is a problem, we can always go back to them and sell the book and get the money out and pay back the lenders. So we can solve a mismatch like that, right?
Because this is This is getting very interesting. Sorry to cut you. One more question, which you can imbibe in this conversation. Then, what's your average borrowing and lending maturity? I mean,
So let me explain that. Well, that's what I was getting to. But that does not mean that we don't have. So the effort of keeping the money longer is what happens, right? So the one effort is to ensure that your freedom is moving to fixed plans. That's the reason there is only 18%. If you look at competition, they have 60% in freedom. For example, some of the large players who tried P2P lending, Fred and other guys, had most of the money in freedom.
Sure.
Okay, Bharat Pay and Fred. I don't want to name, but we don't work on that principle, right? So our model was to kind of make sure that the money is moving to fixed plans because we have time, we have a little bit of predictability there. The other thing is that once it moves to fixed plans, what we've seen is that there is a high percentage of retention we have. We have a retention close to 90%.
Oh.
Okay, so people don't take the money out. They just keep it there to kind of make them more money. And on the borrowing side, 24% or 24 months or 28 months is an average. A lot of customers pre-close their loans, especially these business guys. Unlike a salaried customer who would not, because it's tied up more with their salary coming in. And business customers, if they get a windfall, if they get a decent money coming in some month, they will pre-close their loans. Okay, so we've seen more pre-closures happening in. On one side, it is good, but on the other side, the anticipation of the income that you made with that particular customer, kind of comes down. But you can always invest in some other guy, right? So there are a lot of people.
Your average borrowing book will be what maturity?
Borrowing book, how long we've been reading?
No. I mean, what's the average tenure for which people invest their money?
Oh, they invest for long term. So I think 2.5, 3 years, 3.5 years.
Correct me if I've understood this, and for the viewers, right? Your borrowing book, I mean, people who are investing, they are also investing for a roughly 2.5 year, because you're not really encouraging them to put money in liquid, which is your freedom plan.
That's right.
Only 18% of your total book is there, out of which also 10% you keep extremely liquid to service whenever people are asking for money.
That's right.
So average investment tenure or your borrowing book is roughly 20-24 months, and your lending book is also 24 to 28 months.
But that is on reinvestment, right? So it's not like we don't call money for 3 years. Because there's no point. People are not going to give you money for 3 years, right? So you call money for shorter duration, but eventually those customers, they lock in with you for long term, right? So there is a very high repeat, right? Very, very high repeat, right? So 90% upward of repeat business. And it's true for this category of business because he's making money, right? So once he's making money, he does not want to kind of take that. It's giving you better than FD, right? Double than what you get in FD.
Yeah.
Fixed deposits.
Super. I'm enjoying this conversation.
Okay, so this is the other piece. In fact, the most important piece, which is the collection recovery. So, as an organization, most of us do this. I don't know. I can't comment on others, but large NBFCs and banks do it. So they have a 4-tier, collection process or a system, right? So one is the call center, which is a captive in most cases. In some cases, it is outsourced also. But in our case, it's captive. Captive call center, which basically calls out these customers who are delaying the payments, right? Sure. And we have some system with the bureau, running for this particular piece, right? So which is called early warning system. So what it does is that we track borrowers bureau on a monthly basis. And if there is any trigger which we feel which is not good with respect to that particular customer, there is a priority given to that customer to call on, right? For example, if his CIBIL score has come down, okay? If he has taken another loan after our loan, immediately. If he has not paid to another NBFC, okay? If he has taken another credit card, okay? Or if he is moved to another address, or if he is another mobile number is showing on his bureau, right? So any trigger, there are some 15, 20 triggers that we have parked with Bureau. If there is any trigger which we get, if you see, those customers are prioritized and called first, okay, for the EMI. And the reason is that early warning tells you that this customer is going to default in the next 2-3 months. So you might as well engage with that customer right away and get your money in, right? So you pre-close whatever, you push the pre-closure. If you're the first one to kind of push for legal notice, if you're the first one, so the chances of you getting the money becomes higher. So that's the reason we kind of do that. So call center is basically it's very controlled. Scripts are basis the delays. So if you are in the first bucket of delay, then the way you talk is different than if you are in the 90th day of the bucket, right? So the tonality, all of that changes a little bit. But we adhere to all legal ways of collecting money. We don't do any threatening, we don't do any abusing, nothing of that sort happens. So it's a very legitimate way of conducting the business. Second is, once the call center is not able to reach the customer, let's say is not contactable, if he's skipping, if he's not picking up the phone, any of those events happen, or if he's moved out of that particular place, which I talked about, salaried customers move a lot. This is given out to field. The field team, nationally, we have tied up with a lot of agencies. The agency people go to this particular customer's house, residence, to figure out and establish whether the customer is still there or not. If he's there, then they will push them to kind of do the repayment, right? So all of that happens. If the field is also not able to convert the customer or pick up the money from the customer, it goes to the legal team. Okay, and legal team, we have dedicated lawyers. We have online mechanism also to do resolution. Even the legal team's engagement with the customer is not to do a legal case or threaten them or all that. Their engagement primarily to kind of get the money out.
Sure.
But we do the entire 9 yards, right, of sending the legal notice, dunning letters, section 138, all of that we do. Summons are served, all of that happens in case if the customer is not paying.
Okay.
All of that intervention helps us get money, right? So a very small percentage of customers get into legal cases. Majority of them typically are the ones who either have lost their business or they have have some medical problem, either himself or the family members have a medical problem. In those cases, we wait out and wait for the customers to kind of come back and then pay. Otherwise, in cases where they are trying to act smart, we kind of go legal against. Now, all these 3 sets, the first 1, 2, 3 sets, in spite of that, if there is customer is not contactable, okay, after field and the legal and the customer is not contactable, we come to the fourth step, which is the skip tracing. Now, this is nothing but data analytics, where today we get different kinds of data available, and these footprints, customers, which are leaving behind, it's getting bigger and bigger as we go along, right? So earlier it was only Naukri data or whatever. Today you have or Naukri or India Mart data. Today you have a lot of data available. There is shopping data. There is delivery data. A lot of data is today available. Utility bills data, ITR data, bureau data itself gives you a lot of information. A lot of data is crunched to see whether a customer is leaving any footprint, and if there is any footprint being left, you can contact the customer. So let me give you an example. So some of the data that is getting opened up, one of the data sets which is getting opened up is the car manufacturers dealer distribution network. Okay, has opened up the data to lending companies, and the reason for that is that more than 60-70% of the cars are getting financed. So it's important to kind of have that arrangement with the lending companies to share data. Okay? So if you have a car, and if you bought that car from Delhi, and if you have kind of driven it to Bangalore, and now you're not paying the EMI, okay? So, but you're lazy enough to drive the car to the service station. The guy comes to your residence to kind of pick up the car and kind of take it to the service station and deliver it back, right? So that's the facility the car companies, the dealer network gives you. So, but you leave your data behind, right? And that data is being shared by lending companies. So lending companies will get to know your current address. Okay. Similarly, government has opened up the cylinder return. So your cylinders that you have, your IOC Indian, up to share ek hi hai. So that data is opened up. So today, if you're moving from one location to another, you have to cylinder that cylinder to the agency that you are getting the cylinder from, and go to the new town and go to the nearest agency and get the cylinder, and the cylinder gets delivered at your home. Your new address gets picked up from there. So today there are a lot of data points which has come about. It's very difficult to kind of take money and just run away. You're leaving a lot of footprint there. This is a science which we are building, and as we go along, this is getting bigger and better.
Wow.
So that's the four parts to the collection.
Does the mobile company actually give you live data?
See, mobile search data is there. It will not give you live data, but there are companies who are giving APIs for live data today.
I was just.
तो क्या करते हैं ना, जिसको भागना होता है ना, वो मोबाइल नंबर ही छोड़ देता है. He will chunk that number and take another one. And we've seen that more in salaried customers. Business customers में नहीं देखा.
Super.
Okay, so we're pretty much towards the end of it. Why should you invest, and what is it that you should look for? Okay, in an asset class like P2P lending, right? So I'll just recap it. At least what are the we have more than 200,000, 250,000 investors, and what is it they look for, and why are they participating, right? So one is on the asset I talked about. The asset is small business or salaried customers, right? So that's the asset that you're putting your money in. Okay. So that's a choice you have to make. You want to kind of put in small business, or you want to go and pick up an asset which is more focused on salaried customers. Ours is a small businesses, customer base. We have the experience and strength. We have been doing this for the last 10 years. Okay. So there is a little bit of vintage that we have set in, and that vintage is not it's not about just about tech play, right? The system, the procedures, the process, the great experts, all of that vintage over a period of time, helps us perform better. Right? And there is a decent track record with a lot of transparency that we've built for our customers. Four is that we don't have any concentration risk, as I talked about earlier on. It's well calibrated with analytics. We cut across, and if we see any concentration, we kind of mitigate that. Because hota kya hai ki there are some channel partners who will suddenly get activated and will start to kind of flush a lot of borrowers. Let's say we pick up a lot of borrowers from, let's say, Calcutta. I want to put brakes and say, about Calcutta is enough. I will cut Calcutta right now and kind of bring the portfolio a little less of Calcutta for the time being for the next 2-3 months. So all that calibration can happen when you're looking at data minutely, right? So we do that and avoid all kinds of concentration risk. So, for example, we used to do earlier partnership loans. Okay? We had partnerships of 60 companies, and we've done away with that because partnership loans, let's say, for example, MobiKwik ke saath partnership, Paytm ke saath partnership, different partnerships. We have healthcare companies ke partnership, education companies, Byju. So these partnerships, exposes yourself to a concentration risk. Okay, so we've done away with that. So we want to kind of, give out to small businesses across the country. The platform's performance with respect to fractionalizing the money. So your money does not go, as I said, 50,000 to one borrower. It's broken up into even smaller units. Units as small as 15 rupees, 20 rupees to one borrower. So the way it works is that, let's say there are 10,000 borrowers currently on the platform. When you invest, a lakh of rupees, that lakh of rupees gets distributed to 10,000 borrowers. So your money is not, put out to very few sets of borrowers. The way we have built this is that it is, and when it go out, the new set of guys replace that, right? So it's kind of to all the borrowers who are live active at that point in time. So that's the way fractional, exactly the way the mutual fund works, right? So we fractionalize that in that way. It's just that mutual funds money that is riding on is on very few set of large enterprises. Ours is the retail, right? That's the only difference.
Vinay, just to clarify, help me if I've understood this well. So we are saying that if there are 100 people who are willing to invest onto the platform, right? And one of those hundreds have invested 1 lakh, that 1 lakh is distributed amongst
all the borrowers who are live on the platform.
Some let's say 1,000 investors, borrowers. Now each of these borrower is not wanting to borrow 15 rupees, but from my investment, 15 is given out to 50,000 people. Correct. Similarly, from another guy, 15 rupees will be given. So one borrower who's borrowing from your platform would have received 15-20 rupees from some 1 lakh investors or 1,000 investors, right?
That's right. So the more borrowers I onboard, the lesser, per borrower my lender's money is exposed to.
Sure.
In fact, we did this even before, regulation was spelled out. So we're going to do it at 500 rupees, as low as 500 rupees per borrower. Anyway, so that's beautifully fractionalized. Also distributed, right? So we, as I said, we operate out of close to 2,000 cities and some crazy 25-30,000 pin codes, right? So it's well distributed across the country, right? And we are, different loan types. So why I'm trying to explain this is that to explain there is no concentration risk. We don't lend to only, let's say, manufacturers. We don't lend to only, let's say, restaurant owners, right? So we cut across all. We lend to doctors, restaurant owners, lawyers, kirana shops. We cut across various segments and various different types of loan types. The credit policy today that we are hosting is a machine learning, right? And to get to that stage, you need enormous amount of data. You can't have a machine learning, models built in the first, second, third years of your operation, right? So you have to have enough and more data for you to start predicting, analyzing, and post that the machine learning can predict. So ours is to reach that stage. A collection I talked about, we have a 4-pillar, 4-stack collection process, right? The other reason that people are today investing is because this is one of the highest return in the debt investment. Okay? And obviously it's backed by individual loans and contracts. So when you do any debt investment, the reason you do debt investment is because it's backed by loans and contracts. This also is backed by loans and contracts. Obviously it's RBI regulated. And this is the first time you're getting participation in the retail loans, retail assets. Okay, the retail asset, especially retail loans, this investment has no relation to any other asset class. Okay, a mutual fund, stock, all of that is related. If something happens, your portfolio, if there is a bad news, portfolio goes. This is more like a real estate or a gold, absolutely no relation to any other asset class. Right, so this is a different asset class, and it makes sense and gives you a return of 12%. ROI is fixed. Okay, we've honored all the returns to all our customers the last 3 years since the time we started in this model. Right? It's called Fetch and Double. Right? We've been operating for 10 years. Earlier, the model was pick and choose. The lenders used to kind of make the portfolio. We never made the portfolio and give it to the lenders. So the returns also used to vary. Right? Some of them used to make 24%. Some of them used to kind of lose money. But now all of them get similar kind of returns, and we are managing that from our end. Last 3 years, not a single lender has lost money. All of them have been honored 100% return.
If I can just simplify this for the viewers, you are saying prior to 3 years, if I wanted to invest, I would hunt for whom do I want to lend money to.
That's right.
And I might make mistakes, or I might make some brilliant judgment, and hence my return would completely vary from somebody else who's wanting to invest on the platform.
That's right.
Right? So one individual was lending to multiple individuals originally 3 years back.
Yeah.
And over the last 3 years, what you've done is simple. Now everybody lends to the platform, and platform uses the technology and lends, correct?
Yeah.
Okay.
And there is no fee for the investors to participate on the platform. So there is no zero fee for the investors. It is very easy to use. There is a mobile app, there is a dashboard, there is a website, so you can kind of use it very easily. As a platform, we make money only if we perform. So we have based ourselves on performance based, right? So for example, I'm giving return to my lender 12%, and I'm lending at, let's say, 24%. And if I do the default more, then I don't make money, right? Because I have other costs also. I have a channel cost, I have servicing costs. All of that is there, right? So I have to perform to ensure that I make money to kind of sustain myself. So if I make just 12%, let's say I don't make any. The first port of call for me is to give the lenders the money, and then I have to kind of take. So my performance is what gets me my fee. It is not fixed for me. So some months I perform really well, I make more money. Some months I may not perform well, I take. So my endeavor is to kind of make money all the time, perform all the time. The other important thing people look at, investors look at, is that who are your backers as an organization, who's backed? Okay? What does your cap table look like, right? So for us, it's very important. I'm not going to name all of them, but we have ICICI Bank, GM Financial, Muthoot, some of the banks, large NBFCs and banks in our captive. Okay. Now, why do these companies have invested? You have to understand. Okay. Because the market was open for them to kind of pick and choose so many of them, right? So they chose us primarily because the process that we run, the policies that we have, the transparency that we build, those are important for them, right? Because they've parked small amount of money with us and taken some equity, right? For them, it's a very small decision with respect to the money, but with respect to whether their credentials are going to get compromised, whether their reputation is going to compromise is more important. So they run a proper due diligence for 2-3 months before they park it. So we have kind of baptized by fire, if you ask me, by these large NBFCs and banks for them to kind of be our partners. So that's very important for some of them. Plus, we have Mohandas Pai as our advisor. We have some Japanese investors, a bunch of them. Very difficult to get Japanese money. They come with a lot of trust and all. So this speaks about, as an organization, how we are and how we. Plus, we are an EBITDA positive company. So we make our monies and we're able to kind of sustain ourselves. We don't rely on external. So whatever funds that we raised was before the regulation. We raised all the money, and post regulation we hardly raised it. The last money that we raised was from ICICI Bank. They kind of were very interested. We've been talking to them for a very long time, and they parked money after COVID. Around COVID is when they parked money. So even during that time, they showed confidence in our system, process, all of that. How we are regulatory compliant, how we are taking the regulation framework, all of that very seriously. All the compliance work, all of that is very important for them.
Vinay, is it not a conflict of interest that ICICI is on your captable and they are only your trustees?
No, so ICICI Bank has invested, and ICICI Trustee is a different company.
Okay.
It's a completely different company. The other thing is that a lot of customers come for social investing because we are giving out to small businesses. We are creating employment. We fund a lot of women entrepreneurs, especially in small towns and rural areas. So a lot of unserved and underserved market we're catering to, which a lot of people take pride in lending, right, or pride in investing, right. It goes to a good cause, right. You're creating that value for the nation to grow, for unemployment to kind of go away. So all of that a lot of people resonate with, and they come and invest. So that's, I think, and what value that we drive to our borrowers, and that's one of the reasons the investors look at to kind of drive. One is that we are able to provide credit to unserved and underserved, credit at lower rate from whatever they're getting. They're not getting from banks anyways. Right? They might be getting from other NBFCs. We are, giving them cheaper than that, or they might be getting from money lenders. We're giving cheaper than that. That's the reason they come to us. Because otherwise, large number of customers will never come to us. Large ecosystem players or DSA players will not participate with us if you're not cheap. So we give cheap loans. We give them faster. We have a very fair and transparent process. The customer can see through the app the entire process where he is right now in the journey. And we don't take any collaterals which typically NBFCs take. We don't take any. All of that is non-collateral loans that we give.
So when all your loans are non-collateralized, right? Okay.
We believe in the small businesses of this country.
That's good to say, and I hope that stands true.
Yeah. No, I'm very bullish about it. See, if India is growing, it's because of these small businesses. The growth is coming from these small businesses. It's not coming because if you look at the large businesses, okay, and it's not just India, globally, okay. Yours and mine, a lot of money is riding on these small business, large businesses, right? If you look at majority of the money is sitting either with top 100 companies of this country or the government. All right. To keep a pace with these 100 companies who are going to be relevant, who are not going to be relevant 10 years from now, it's very difficult.
Yeah.
Companies are getting disrupted because of technology. So if you look at US, the top 10 list has completely changed the last 10 years. Completely changed. Only one company is there now, which is Walmart. The rest, all of them have changed. India will also see through that. So your mutual fund riding on some companies. So why is it that a debt mutual fund today is giving you negative returns or no returns, right? ILFS, Divan House, all these companies, yes, all of this have failed primarily because a large sums of money riding on very few companies, and those companies may or may not be relevant today, or maybe may or may not be relevant tomorrow. And I'm not talking about companies which are, where there is a lack of governance. I'm not commenting on that. I'm talking the business model itself doesn't make sense. Okay, so sometimes business model is outdated. Sometimes the customers move on. Nokia was a perfect, fantastically run company. The customer just moved on to a new set of, phones, right? They couldn't. Kodak was a great company. The business model completely got this. So companies to keep track whether they're going to get disrupted or not is very difficult. And that's the reason fund managers can't get it, straight 3 times right. So they might get 1 or twice right, but 3 times, then none of them across the globe have got it right.
No, I might have a very different view on the discussion here. But the point is that if you have collateralized assets, I think it's slightly a more secure.
No, I'm not talking about the collateralized part here. Right. See, collateral, by the way, just to give you a data point, do you know the home loan performance is worse than a personal loan performance in the bureau?
Wow, that's an interesting.
Yeah, you know why? It's because the home loan, the criteria by which you give is not very stringent. Okay,
the personal loan is extremely.
Personal loan, you are very stringent. Okay, that's it. Now the banks don't lose money because they have the collateral.
Yeah,
that's a very lazy way of doing business, right? A credit business. India does not need collateralized loan. India needs unsecured loans. If India is to grow, see, credit penetration in India is abysmally low. The credit card penetration is only 2-3%. Okay, with all the tamasha, right? Personal loan, all public sector, private sector bank put together, personal loan, unsecured personal loan is not even 7%, 7 to 8%. 97% or 98% of the people who have bank accounts, do not get a personal loan or a credit card. That's the state we are in, right? Banks and NBFCs have been lazy enough and been doing collateralized, and they've kind of made the money with collateralized. There are very few banks who tried, to kind of venture out and do non-collateralized. HDFC, ICICI Bank, all of these companies took the baton and started giving unsecured loans and personal loans and all of that, right? And they built a book, and basis that performance, they started giving collateralized loans as well, not the other way around. So, Citibank, they were the first who started the unsecured piece in India, right? G Capital says. So what I'm trying to say is that the investments that you're doing on an asset, if you're doing it in a mutual fund, it's now going to, let's say, 100 companies, compared to a P2P investment, which is going to, thousands of borrowers, small borrowers. Between the two assets, 100 companies of India in the next 10 years, and thousands of borrowers, and which is going to change obviously every 3 years, thousands of borrowers in India. I believe in these retail borrowers more than the top 100 companies, because their business model can change and get disrupted in the next 10 years. Right? We don't know. And that is the reason the sharing economy business has become or boomed in the last 10 years in the world. Because in the absence of data, okay, people believe people more than organizations. This is a very interesting thing, right? Why do you pick up Uber? Not because it's cheap, because it's transparent. Okay, where he's, how far he is, how many trips he has taken, what is his rating, what is his car, what is his car's number. That transparency gives you a lot of comfort.
Yeah.
Okay? And that's the reason these businesses have become very, very, multi-billion-dollar businesses, right?
I hear you well. Yes.
Yeah. So I think retail has its own strength, and if it can be presented and put out properly, I think there are many takers there.
Interesting.
I think that's it.
Awesome. Vinay, this is actually amongst the biggest episodes that I've done so far, and very interesting how you've presented.
Are we going to put this out in half an hour?
No. I'm gonna try and put everything without editing anything that we've spoken, because I think while I ask you questions, there are a lot of things that viewers will understand, because there are very specific reasons that I'm asking you those questions, because I've gone through this journey on the fixed income side for everything that you spoke since the start to the latest fiascos that have happened. And great that you've highlighted it. And my specific reason of asking you a lot of these questions was because I know my audience looks at me as somebody who understands a little bit of fixed income. So I wanted to make a lot of these things that you were talking very, very simple for them to understand from both risk and return perspective. So I'll try not edit anything that we've spoken. And I think this was a great conversation. I'm sure along with me, a lot of people who are going to hear us will end up learning a lot from our conversation.
Yeah, hope so.
So Vinay, thanks so much for taking the time out. I'm sure everybody listening to you would have actually understood a lot about the P2P infrastructure. And I'm just hoping that any and everybody who's listening in, please do leave us your comments to try and make this series a little better. Do subscribe to our YouTube channel, click the bell icon. We'll bring one such expert every week to talk to you about various things to do with investing. And I'm hoping to receive more feedback so that we can learn, grow. And if you know of some expert that you want to call us, want us to call on the show, please do write into us, and we'll be happy to get them on the show. Thank you so much.
Thank you.
Thanks.